Thank you, everyone, for attending. This is the ups and downs of insurance and how to handle the roller coaster ride. We're going to go into where we are right now, um, and what you can do to make insurance a little bit more palatable. So first off, let's just get into insurance is cyclical, like a roller coaster. There are hard markets and there are soft markets. So there's ups and there's downs. And to understand that, and need to know how insurance companies make money. So insurance companies make money in two ways. One is underwriting profit, which is collecting more premium than the total of losses paid and expenses. And that sounds, routine, but that's one way they make money. So if they're making a profit there, what they do is they take that plus the premiums and they invest it. And that investment income is the second way they make money. So investing the premiums and collecting interest. So when an insurance company is making money in both ways, they're happy and they're looking for more premium. And we're going to get into that in a second. You may ask where we are right now. Unless you've been under a rock for the last 5 years, we've been in the worst hard market in the history of real estate. I've been doing this 31 years and I've lived through hard markets, Sandy, 9/11, and others. And this one is by far the worst. So, what is a hard market? Hard market is basically when an insurance company is losing money. So they are not charging enough in insurance premiums to offset losses and to be profitable once you factor in expenses. So typically, an insurance company typically wants their insurers to have a loss ratio of 45% when preferably less. And that means for every dollar they collect in premium, they don't want to be paying out any more than 45 cents of that dollar in claims. Because when they factor in expenses, they start losing money if the loss ratio is above that percentage, depending on how much they're making in investment income. If they're not making enough investment income and they're not making money on underwriting profit, then they need to raise premiums, and that thus begins the hard market. Okay. What else goes hand in hand besides a premium increase during a hard market? Stricter underwriting guidelines. All of a sudden, insurance companies want more life safety. We want emergency lights. We want sprinkler systems. We want hardwired smoke detectors, things like that. All different things they didn't require before. They also have more loss control recommendations. So anytime an insurance company writes a new property, they're typically going to inspect within 60 days, and they're going to come up with loss control recommendations that they feel make the property safer because they are the ones who have to pay the claim. So they go out and they do these. All of a sudden, they want upgrades from fuses to circuit breakers. They want emergency lights in the stairwells and common areas. They start increasing deductibles, both the property deductible and deductibles for water damage. This puts more of an onus on the insured and helps reduce the severity and frequency of claims. So a $5,000 deductible may go by the wayside and they may say, well, renew you, but we want 10,000 or we want 25,000. In some cases, they start adding per unit deductibles, which puts a very big onus on the insured if multiple units are affected. And we'll see this a lot of times in high-rise buildings or properties that have water damage claims. So instead of, okay, we have a 5,000, they call AOP deductible or all other perils, they'll have a separate deductible for water damage, and it may be $5,000 per unit. Well, in a high-rise building, if we have a 20-story building and there's a pipe that bursts on the 18th floor and leaks all the way down, well, we may be looking at a $9,000 or $10,000 deductible, excuse me, or $90,000 or $100,000 deductible just because of water. What else happens? Reinsurance companies start raising their rates. Now, understand that reinsurance companies are insurance companies for insurance companies. Most insurance companies only take a certain portion of the risk. So, for example, if a building is insured for $50 million, they may only actually be insuring 25 million of it in-house. And what they do is they go purchase reinsurance from another company or reinsurance company for that other 25 million. What that does is it limits their exposure. Well, if a lot of the times during these hard markets with disasters worldwide, these reinsurance companies start raising their rates. So then the reinsurance company, the rates flow down. The insurance company has to pay more money, so they charge more to the insureds. They have reduced capacity, meaning they can't provide higher limits as they were before. This could be building coverage, could be flood coverage, it could be umbrella coverage. Sometimes it's their choices. They just want less exposure, and they'll say, okay, well, we're not putting out 50 million in coverage. We're only going to put out $20 million in coverage. And sometimes they're simply unable to do so because, again, if they're buying reinsurance, or that example I gave a minute ago about $50 million worth of coverage, if they don't want to buy that reinsurance for that extra 25 million, they're only going to be able to put out 25 million. Well, all those buildings they were insuring between 25 million and 50 million, they can't insure anymore because they won't buy the reinsurance. So a lot of the times they may choose not to pay for reinsurance because they can't charge enough of a premium to the insured that it makes sense for them to purchase reinsurance. They also start requiring more years of loss history. In a hard market, 5 years is a minimum. A couple of years ago, in the midst of this hard market, we saw insurance companies who were requiring a look back of 10 years to see loss history. And so something that isn't a problem in a soft market 6 years ago or 5 years ago, all of a sudden now is they look back and say, well, what was that claim 5 or 6 years ago? And they want more details. And then what we'll see is accounts with unfavorable loss history will see larger premium increases than usual. And the insurance companies are much, much quicker than non-renewal account that has had losses, even if it was done one fluke loss and even if the insured corrected the issue. So there's less patience, there's less tolerance for losses. Other factors, in addition, accounts that have losses, especially ones that have not been closed out, find it difficult to find replacement coverage at a competitive premium and often see triple-digit increases. So when we say have not been closed out, an open claim is always going to be worse than a closed claim, and both from a property perspective and a liability perspective. So on the property side, an open claim means, okay, we took damage, fire damage, water damage, whatever it is. Repairs have not been made at this point. And so the insurance company sees that may be a $25,000 open claim. And they say, well, no, thank you. We don't want any part of it, because on the property side, if there is another claim damaging that same area, there's no way to distinguish between the first claim and the second claim. And there's been instances where the insurance company who went on to the risk afterwards was required to pay for the initial claim because there was damage to that unit again or that building, and now they have to make the repairs because they don't know what was damaged previously. So on the property side, that's the reason why insurance companies don't want to go on an open claim. On the liability side, it's worse from an open claim. So hypothetically, so what happens is when an insurance company has a claim or you have a claim and you report it to the insurance company puts what's called a reserve. And a reserve is basically what they estimate they're going to have to pay for expenses and judgment or a settlement to get out of it. And so they may reserve something for 50,000 or 250,000 or 500,000, depending on what the injuries are and what the situation is. And so an open claim is worse because if that's paid out and closed, they know exactly what the damages were. Well, an insurance company taking a look at an account that has an open claim may say, okay, well, we only got a $250,000 open claim, but you know what? A week or two later, that they find out there's more injuries, and that reserve all of a sudden goes to $2.5 million. And so insurance companies don't want to be involved in an account that has an open claim. And we see more and more of that in the hard market where they will say we're either not quoting, or the company that's on the risk will all of a sudden just say we're making our money back and have a huge increase. These last couple of years, everybody's probably heard HPT violations has become a big issue, even smaller ones. So buildings and many buildings have these violations because it's very difficult sometimes not to. And the small ones which aren't a problem and can be corrected, and sometimes the large ones take a little while to be corrected. But insurance companies start having problems with them in the hard market. And in the soft market, more and more insurers end up in the excess and surplus lines market. That's known as not admitted companies. So if you hear the term not admitted insurance companies, that's what that means. Not admitted insurance companies are not licensed in the state, but they can write insurance here. They can operate with greater flexibility compared to admitted insurers because they're not bound by the same requirements regarding policy forms, rates, cancellations, things like that. So not admitted companies are often used to cover risks that are considered high risk. So there is a need for them. Most contractors are insured by them. Anything with chemicals, dry cleaners, things like that are probably going to be not admitted insurance companies. What happens is condos and co-ops start having losses or are non-renewed by the admitted companies, they have no other choice. So they end up in the non-admitted territory, which again, there's a need for it, but what happens is some difficulties that we'll get into shortly. And here they are. The downsides to being insured with a non-admitted company is, first off, they do not participate in the state guarantee fund. Insurance companies contribute to a guarantee fund in their state, so that way if an admitted insurer becomes insolvent, creditors and insureds have some recourse. Okay, so it's like they're putting money into a pot in case one of them goes bankrupt. Insureds with not admitted insurers cannot seek reimbursement for claims from the guarantee fund because the not admitted companies don't pay to that guarantee. Second, since not admitted insurance companies are not subject to the same rules and requirements as admitted companies, policyholders do not have the same level of protection with as they do with admitted insurance companies. So let's say the Department of Financial Services, known as the state insurance department. That means they can't complain if they're not getting proper notice of cancellation. They can higher premium increases. These insurance companies don't have to file with the state insurance department in New York. They can basically, they're flexible in what they can do. And so they have more exclusions on their insurance policies as well. Whereas in New York, things have to be approved by the Department of Financial Services. And so they may not allow for a large premium increase. They may not allow for certain exclusions. So for example, in New York, mold cannot be excluded from an insurance policy as long as it was a result of a covered cause of loss. Well, that's not the same with non-admitted insurance companies. They can and generally will exclude mold all day long. And since non-admitted insurance companies are not regulated by the state's insurance department, if you're unhappy with the way they've handled a claim or other situation, you can't file a claim or a complaint with the state insurance department because, again, the non-admitted company is not domiciled in this state. And I'll say it again, although there are downsides to non-admitted companies, there is a need sometimes, especially in the hard markets, because if no admitted companies are willing to quote, where else do you have to go? And that would be the non-admitted companies. All right. What is the soft market? Soft market is kind of like a buyer's market. Insurance companies are making a nice profit on their investment income. And so the prior years, they were making money on the underwriting income. So now they're very, very happy and they want to make everybody else happy. So they start charging lower premiums because what they want to do is they want to obtain more premium and they want to take that and they want to invest that and make that investment income. So they're willing to literally undercut each other to obtain a binding order. And so examples in the past, you have a building that's paying $30,000, the renewal comes in at $28,000, another carrier quotes at $26,000, and now the incumbent goes down to $24,000 because they want to hold on to that risk and they want the premium. So you had a building that was paying $30,000, all of a sudden it's paying $24,000, and that's what happens in the soft market. What else? Relaxed underwriting guidelines. Things that may not have been an issue during the hard market, have been an issue during the hard market, may not be anymore. So the insurance companies don't require as much life safety. And even if they do have those guidelines, they may not enforce them because they want that premium. They're also willing to start offering lower deductibles to attract insurance. So, okay, that's $25,000. Hey, we're willing to do $5,000 now. They have increased capacity. And that's what we've been seeing a little bit lately with carriers is, okay, they can provide more coverage as the reinsurance rates drop. So when reinsurance companies are making money, okay, well, they charge a lower rate, kind of like the insurance company. And so now this cost of reinsurance drops, so the insurance companies can buy that reinsurance, and now they can give you higher limits and at a lower premium. Less loss history is required. In soft markets, typically only 3 years is required. Occasionally, I even see carriers who will provide quotes subject to receipt of loss history. Say, here you go, here's the quote. Just give us the loss history before binding. I've seen situations in the past where insurance companies have bound without loss history, so we'll give it to us afterwards. And so it's kind of like the wild, wild west. They want that premium, and so they start looking the other way at things. And insurance companies are more apt to look the other way when there's unfavorable loss history, even if insured can show they addressed it. They want that premium. So they're saying, okay, you took care of this one. That's fine. We're good with that. And so they're willing to be more flexible when it comes to losses. And all of a sudden, what's an HPD violation? They're not looking at that as much as they used to. Oops, excuse me. How to make your property more attractive to an insurance company, regardless of whether it's a hard market or a soft market. But more so in a hard market. Correct those HPD violations, okay? Some are easily correctable. Correct them if you can. Things as elevators not being inspected, smoke detectors not being functioning, clutter in the hallways, things like that. Those are easy enough to correct. Some insureds may not even know they are open and are not resolved. Violations can be easily accessed on the New York City Department of Building website, and no login is necessary. So you can be assured that even in the soft market, the underwriters will be checking. And that's something that's probably going to continue. Before this hard market 5, 6, 10 years ago, nobody's really checking these violations. Now that they have started, they probably will continue to do so. So it behooves you to make sure you understand what your violations are and correct them when possible. Keep your claim reporting to a minimum. All right. This especially applies if a claim is below your deductible, as it won't be covered anyway. So I see situations where they got a $5,000 deductible, it's a small fire, and they want to report it immediately. Um, I've seen situations where they have a $5,000 deductible and they get an estimate at $6,000 to make the repairs, and they submit the claim anyway. And they want to collect that $1,000. I got to tell you, it does not make sense. And 99 out of 100 times, carriers want clean loss history, clean claims history. So by eliminating the claims you can, that makes your loss history much more attractive in the long run. Whether that's a soft market or a hard market, that is the single biggest reason claims premiums go up is claims. In many cases, the insurance company, I always say a large claim is much better than 5 smaller claims. Okay. So in many cases, loss frequency is worse than loss severity because the carriers are looking for repeat issues, meaning if you had 3 burst pipes, 4 burst pipes, well, they're thinking, do we have plumbing problems here? We haven't paid out much yet, but we're probably going to end up paying out a large claim at some point. Same thing with slip and falls. If they see multiple slip and falls at the property, they're thinking, well, is the sidewalk an issue? Or is the super not getting out there and salting and shoveling when it's snowing? And so again, the thought process is the same there as well. All right, well, we haven't paid anything out at this point, but it's only a matter of time until we do. So if you could, they associate it with maintenance and think the maintenance is done. So if you can repair and mediate any problems that at get-go, great. But submitting the smaller claims, especially on the property side, is not a good idea. You're better off reaching into your pocket for a couple of dollars and keeping those claims off record. Because what that'll do in the long run is that'll make it much more attractive to carriers when we remarket the insurance. Increase your deductible will also provide savings, and that'll limit the number of losses that you can submit. So when I first got into the business 30 years ago, everybody had a $500 or $1,000 deductible. Over the course of time, everybody started having a $2,500 deductible. Now on the low end, most people are at 5,000. So if you have anything less than that, and more insureds going to 10,000, you need to think about doing that because one, not only does it offer immediate premium savings by having a high deductible, but two, it restricts you from submitting those smaller claims. And those, I'm telling you, I'll reinforce that will get you in trouble. All right. Update your electric from fuses to circuit breakers. It's surprising how many buildings still have fuses these days. And it might be downstairs, the main panel downstairs, or it might be in apartments, or it might be both. But insurance companies, most of them, whether it's a hard market or a soft market, will not quote any building that has fuses. Unless you can say, well, we got 2 apartments out of 50 that have them. And they may look the other way, depending on what kind of market. But I can tell you a main panel, a majority of the apartments having fuses, the insurance company is going to say, no, thank you. And insurance premiums, basically, it's all about supply and demand. And so whatever market we're in, if it's 10 insurance companies are willing to quote, you got a much better chance of having a lower insurance premium. If only one insurance company is willing to quote, well, you're probably going to end up paying more whether it's now or in the long run or both. So you need to factor in what it's going to take to upgrade from fuses to circuit breakers. Now, in this day and age, there's a couple of different types of circuit breakers which are no longer acceptable by the insurance company. One of them is Federal Pacific stab locks. And so those breakers are basically known to be defective, meaning, all right, well, they've run some tests, and 1 out of every 3 of them will not shut off when it's supposed to. So the theory with the circuit breaker is, okay, if it becomes overloaded, circuit breaker shuts down. Well, if they're not shutting down, things can be overloaded, and that causes fires. So buildings, and a lot of them have these Federal Pacific. So what happens is the insurance company goes in, does an inspection, finds out they have Federal Pacific stab lock. either rescinds their quote or issues notice cancellation, or says immediately, we want these replaced. Yes, it can be costly, and this is the reason why you want to address in advance, is so you can come up with some kind of plan to replace them. But they need to be replaced because, again, as they said with fuses, if you have 10 insurance companies willing to quote, you're going to do better. Or with stab locks, you may be lucky if you only get one quote, okay? And you may end up in a not admitted market because you have these stab locks. So in any market, it's your electric taking a look at, make sure it's acceptable, and replace it if need be. Take care of your loss control recommendations in a timely manner. Loss recommendations used to be more of suggestions from insurance company to limit your exposure and liability and what they have to pay out in claims. These recommendations are no longer suggestions. They are mandatory in almost every case. And if they're not completed within the time frame provided, most insurance companies will non-renew coverage or issue notice cancellation due to non-compliance. There's even several insurance companies out there who have taken the tactic of said, listen, we've issued loss control recommendations at the policy year. If they issue notice cancellation and then you do and complete the loss recs, they're still not rescinding the notice of cancellation because they're saying, well, we're not liking the fact that you waited to the last minute, and so they won't even rescind it at that point. So any loss control recommendations should really be addressed as long as they're reasonable, and most of the time they are. Sometimes they are, and that's where you have a conversation with your broker. But the carriers want to know that you take pride in your property and will fix what needs to be fixed in a timely manner. And as annoying as they are, and they can be, they help minimize claims. And again, we've talked about claims being the single biggest reason why premiums increase. But the way I explain to insureds is it's almost like getting a free engineer's report, because the insurance company is going to go out and tell you if there's problems, whether it's a defective sidewalk, an elevator that isn't stopping level, or you may need some work done. They're letting you know this needs to be done. How to make your property more attractive? We'll continue. Transfer the risk to contractors, okay? Hired by both the association and the owner. This is probably one of the biggest things you can do. In New York, we have the most unfriendly labor law claims in any state. They are almost completely against the property owner. And so basically what happens is if an employee of a contractor is injured because of workers' compensation, they can't sue their employer. So who do they sue? They sue the building owner. And the labor laws basically hold the property owner responsible in every case, especially cases where there is height related, it's known as the scaffold law. If there is a claim involving height, it's almost impossible for the insurance company to get out of it. So what you want to do is any contractor hired by, and let's start with the property owner, should provide a full copy of their insurance policy for the insurance broker to review, a copy of the contract that is going to be signed. There should be a contract, and I'll explain why in a second, and their certificate of insurance for their broker to review. Now, in our agency, with Kevin in mind, we have a department that simply does this for all our clients. You're hiring a contractor. We want to see this information. And what we're looking for is to make sure that, one, there's no detrimental exclusions. We want to make sure that both the property owner and the manager firm are additional insureds. We want to make sure the certificate's in order. And you can't just accept a certificate. The certificate is just a piece of paper unless it has, unless there has some specific wording in the contract. And this is the reason why we want to see a full copy of the policy. In most contractors in their policy have what's called blanket or automatic additional insured status. What that means is they'll name anybody as an additional insured as long as there's something in writing requiring such. So it's not like the old days. In the old days, you wanted to be additional insured. You told Joe Smith Contracting, I want to be additional insured. They would send that to their insurance broker, who would send it to their insurance company. Insurance company would issue an endorsement saying Joe Smith is additional insured, or excuse me, Ed Mackoul is additional insured. They'd send an invoice to Joe Smith Contracting. Here's your invoice for putting Ed Mackoul as additional insured. And you saw an endorsement that said so. Well, the automatic additional insured doesn't say that. It just says, we'll name you, but there's got to be something in writing. And that's the reason why a contract becomes very important, because if we don't get a contract and there is no contract in place, then there's nothing in writing that the contractor signs indicating that he's aware that he needs to name everybody's additional insured, then there's no additional insured coverage. And these lawsuits, these labor lawsuits have gone into seven figures plenty of times and sometimes eight figures. And so right now, we explain that we're in a hard market and the worst one that we've ever been in. This is part of the reason, especially in New York, because these construction claims have skyrocketed, and it's very difficult for the insurance company to defend them, and it's very difficult for them to transfer it back to the contractor. And so what we say is, when we review the contract, if you can cross all your T's and dot all your I's, you have a better chance of transferring this risk back to the contractor and his insurance. Require all owners to have insurance. In the event of negligence of an owner, they are responsible for the damage they cause, whether it be to someone else or to the association itself. And that coverage falls under personal liability in an owner's HO6 policy. So an HO6 policy is known as a unit owner's policy, but it applies to both a co-op or a condominium. And so personal liability covers the negligence of that owner. And so it's important that they have insurance because, one, if they cause damage by their negligence and they don't have insurance, well, it's going against the association's policy. And we talked about the need to try and keep these claims off record. And it's important that they report it to their insurance, because once it's reported to the carrier, the association's carrier, and they adjust the claim, most times they can't go back and subrogate or recoup their money from the owner and their insurance company, because most bylaws contain what's called waiver of subrogation, which basically says, okay, well, you've had insurance that paid for the damage. You can't come back and recoup it from me. All right. So you want to require all owners to have insurance. Many buildings have that requirement. Many buildings don't have that requirement. And it's a little difficult sometimes, because in a co-op, when a shareholder goes to a closing, they're not required to show to their lender that they have insurance. They're only required to show that the co-op has insurance. So there's many a time where a shareholder will show up to a closing and they don't even think they need insurance. That happened to my father. My father's the original owner of this agency, bought a co-op many years ago and didn't have insurance for about 3 months because it never crossed his mind that he needed insurance. So if he could forget, the average person can forget. In a condo, most of the time, there may be some requirements, especially by their mortgage company. So if you're taking a loan, well, then the mortgage company is going to require you to have insurance. But a lot of people do pay cash for their apartments. And you know what? If the condo doesn't have that requirement, they're not going to be required to have insurance. And same thing there. They may not have insurance in the event of a claim. So by amending, and this is something you want to talk to an attorney to, by amending the bylaws or the governing documents, you can get a requirement in that all owners have insurance. That can reduce the amount of claims against the association, because if someone doesn't have their own insurance and they're damaged, well, what's their recourse? Their recourse is to sue somebody. And a lot of times that's the association. So try and require that. All commercial occupancies should be required to maintain their own insurance as well. And they should be naming the property owner and property manager as additional insured. This will require that the carrier for the commercial occupancy defend the property owner and property manager, resulting in that claims that result in their space. So why should the association's carrier be required to defend something that happened in a commercial space? You got a deli, 100 people a day walking in, or well, if someone slips and falls in there, it should fall against the deli owner's insurance, and the deli owner's insurance should be responding and defending the co-op, condo, and property. All right, that is it in the snapshot. Let's see if we have any questions here. Kevin, did you have any questions?
Yeah, I had a few. I was just waiting to see if anyone else did.
Okay. Ask away.
All right, so starting off, how do we get out of a hard market? Or rather, are there any significant signs that tell us we're starting to get out?
From an individual basis, it's not like one condo or one co-op or one risk can get themselves out or get the industry out. When they're not making money, they have to make money. And again, premium increases start doing that and such on. So On an individual basis, really time is usually the main factor because you got to withstand the amount of time where the insurance company starts making money. So everything we've talked about here is you can't avoid the hard market, but what you can do is you can make yourself more attractive so that way you don't take the same hits that other insureds take. And are there any significant signs that tell us we're starting to get out of a hard market? Yes. Usually what'll happen is one, we'll start seeing new insurance companies come into the market. So they'll say, hey, all of a sudden, ABC insurance company pops in and starts writing co-ops and condos. And that kind of will be one of the signs we'll start seeing. And we've seen this recently where insurance companies will start looking the other way at some of their guidelines. One of them, for example, wouldn't write any what's called joist and masonry buildings. They're brick buildings on the outside, wood joist between the floor. They wouldn't write any buildings that were built before 1940. All of a sudden, the other day, they just gave notice and said, yeah, you know what? We're going to scrape that. We'll insure any joist and masonry building now. It doesn't matter the date it was constructed. And the last one usually is we will see they stop, they all of a sudden have a little bit more capacity because, again, as we mentioned, they can now afford reinsurance. So we've seen insurance companies who couldn't insure or wouldn't insure a building for more than 25 million. Now they've come back and said, yeah, we can go up to 50 million at this point. So those are usually the signs that we're getting to the end of a hard market.
Gotcha. So we have a few questions in the comments.
Okay, let's see what our questions what is it? HP? It's HPD. It says HPT. HPD violations of housing property development. There are violations that are issued because someone basically has complained and said there is an issue. Question number 2, why are insurers dropping smaller condo units in New York? What can smaller condos do to combat this, either than the fine suggestion provided earlier? You know what? Again, in a hard market, insurance carriers start thinking differently. And so some of them will run some numbers and say, hey, we don't make as much money on the smaller condos as we do on the larger ones or medium ones. The only things you can really do are continue to make the property more attractive as a whole. So there'll always be, the good thing about smaller condos is that there are no issues with the maximum capacity. So sometimes larger properties will be insured for $150 million. Well, some of the insurance companies can only insure up to 50 million or 100 million. You don't get that with the smaller condos. Pretty much everyone can insure the smaller condos. So losses, again, number 1, try and keep them off record. Number 2, make sure the property is updated where it needs to be: plumbing, electric, roof, things like that. Because when we remarket the insurance, those are the questions they ask. When was the update on the heating? When was the update on the electric? Things like that. And you want to be ahead of the game. You want, right now, I would say one of the biggest things you can do is go out and get closed circuit TV cameras. In New York, the sidewalk laws are very unfriendly towards the property owner. And what happens is if someone slips and falls and there's no record of what happened, it's very difficult for the insurance company to fight a claim. We had a claim recently that settled for about $200,000, and the co-op board was not happy. I can't blame them. But what happened was this happened several years back. They did have cameras, but it only saved the footage for 30 days. Well, the claim came in 6 months later. By then, that time, there was no footage. There was an elderly woman who had some severe injuries, and there was no proof that the co-op did anything wrong. And so right now, my suggestion would be looking into closed circuit TV cameras. These days, they back up into the cloud, and you could save the data for 3 years and longer and avoid any statute of limitations. Please define negligence when an apartment floods the apartment below and the flooding apartment owner's insurance claims they didn't know they flooded, therefore they were not negligent and owe you nothing. Okay, what I tell everyone is most of the time it's not what caused the damage, it's what was damaged. That's 95% of the time. So if you go by that, most claims you can adjust it yourself. So you would look at the bylaws and, okay, well, let's go hypothetically in a co-op, and in most condos, they're somewhat written the same way. The association responsible for the structure itself, original floors, walls, and ceilings, and possibly original everything, including kitchen cabinets and things like that. The owner will have some responsibility, and then the owner will have more than likely the responsibility of any improvements they've made. So if a building was built in 1950, I can guarantee the bathrooms and kitchens have been upgraded. Well, those improvements are now the owner's responsibility. And the owner's personal property is pretty much always going to be their responsibility. So if you think of it that way, if a apartment upstairs flooded, the question that isn't what caused it, it's what was damaged. You start with that. Negligence is very difficult to define. So what I tell people all the time is if a pipe under the sink upstairs burst and caused damage to stuff downstairs, probably isn't considered negligence. If a water heater burst and caused damage, still not considered negligence, even if it was outlived its life expectancy. What negligence is you fell asleep in your bed with a lit cigarette. You left the water running in the bathroom. You did things like that. The definition of negligence is what a prudent person wouldn't do. So negligence is tough to define. And so unless you can prove that it was clearly negligence, you need to determine if you are responsible for what was damaged. And if you are, then it's probably going to be your responsibility. How does a condo in a coastal area mitigate risk rising in a common sense way? I mean, listen, that's tough. That's a tough answer. It's a tough question. You are in a coastal area. I would certainly bring in an engineer. I mean, some of these places have they have a specialty in what you can do to offset some, God forbid, any floods and things like that. It's not cheap, so it's from a common sense way. At this point, it's a little difficult. Building is built. You're in an area where it is considered coastal. The best things you can do is make sure you don't have things in the basement, uh, simply because a lot of the policies are going to exclude things down there. And the good thing is, from a building's perspective, the heating and cooling and all those equipment is covered under the flood policy. You can't move that, so it's a very difficult question. But you can probably speak to an engineer who specializes in flood and the technology, what can be used to reduce the exposure. How would you recommend proceeding in an emergency situation where a condo can't verify a certificate of insurance or obtain contract from a vendor? Listen, emergency situations, you got to get the work done. I say that all the time. Boiler goes in the middle of the night. You got a major flood happening. There's no time. Insurance companies may not be happy with that answer, but the truth is, it's going on in the middle of the night. You got to get someone in there. You got to fix the repairs. However, we have the time to do so. Any major projects? Okay, well, we have a burst pipe there, super shut off the water. I would probably still see if we can get this information there. It doesn't take long to prepare a certificate of insurance. The certificate is useless in a lot of cases, but it's better than nothing. One, it verifies on that date that the contract has insurance. Two, it gives the insurance company and his broker's name. And that could be important because if they cause damage or injury, at least you have on record that they have insurance and you can try and file a claim directly against that carrier. But realistically, if there's time, we want that contract and we want to be reviewed in advance. New Jersey rates for HO communities started to cool down, only about a 15% increase this year we have seen. What can you predict or are seeing for 2026? I'm going to say it's going to be about the same. I would budget for 15%. And so what we're starting to see, and we're heavily involved with the insurance companies, we're starting to see more and more carriers come in and a loosening of the guidelines. That usually, again, starts the soft market. However, I don't think we're going to see the same soft market we've seen over the past 30 years that follows the hard market. Usually, again, they're undercutting each other to get premium. Right now, what we're starting to see is that the property insurance rates are going down. And so I pulled an article out of a newsletter I got yesterday. It said, cat reinsurance bonds are hitting new record sales in 2025 due to current high yields. These bonds provide competition to traditional reinsurers and will likely keep property reinsurance costs down. So property rates going down. And it goes, however, liability insurance prices, on the other hand, are very high due to the effects of socially inflated litigated claims. What social inflation is that basically is the main reason. I talked about in New York that the reason why we've seen premium increases over the last couple of years are these labor law claims. But countrywide, it's social inflation, which is basically is a rise in the amount of judgments that are being given out. And And so society has basically gone the route of, money is kind of thrown away in a lot of instances. And so whether it's a distrust of insurance companies, deep pockets and all, the juries are awarding higher and higher judgments than ever before by far. And so a lot of these they exceed the liability limit and they're piercing the umbrella. And that's what the insurance companies have seen over the last 7 to 10 years, and why we're in this position now is more and more umbrellas are being pierced. So they're what's called nuclear judgments in $10 million and higher. And they're coming out, the term now is thermonuclear judgments, which are like 50 million or $100 million and higher. And the insurance companies are seeing more and more of that. So I would say probably 15%. If you're a good risk and you're a good risk, your losses are good, you don't have the electric and an HOA, you're only, usually it's the amenities that you have to insure. So I would be comfortable with 15%. If it comes in lower than that, then you're ahead in your budget. All right, Kevin, do you have any other questions that people may be thinking?
Maybe one more.
Okay.
So let's say you do have this loss frequency you talked about before,
Right.
but it's not any repeat issues. Is it still going to like drastically affect the premiums or?
It is, especially as you're getting more and more into a hard market and during a hard market. Claims are simply going to affect your premium. And so frequency is normally worse because, again, they're seeing same claims over and over. But if you have had bad luck, you've had a fire, you've had a burst pipe, you've had a slip and fall, three claims is still three claims no matter which way you look at it. So again, the insurance company is in business to make money. We just talked about how they make it in two different ways. Well, if they're not making money the first way, which is underwriting profit, that restricts them from making money on the second way, investment income. And so, yes, you are going to see a premium increase.
Gotcha. Okay.
Okay. Any other questions? All
I'm
right.
good.
I want to thank everybody. I'm going to go to here is Kevin and my information here. If you have any questions regarding anything we've said, please reach out.